This is Chapter 3, Adjusting Accounts for Financial Statements. Today we're taking a look at Exercise 3-14. This is the alternate version of the problem on completing a worksheet. Now, although the problem says it's covering Learning Objective P7, in reality it's covering Learning Objective P2 on preparing the adjusted trial balance. So let's take a look. It says the following data are taken from the unadjusted trial balance of Westcott Company on December 31st, 2016. Each amount carries a normal balance and the the accounts are shown here in alphabetical order. So we have all of our different accounts, and it says use the following adjustment information to complete the worksheet. Depreciation on the equipment was $4. Accrued salaries $9. The $31 of unearned revenue has been earned. Supplies available at December 31st, 2016 were $32. Expired insurance is $32. So let's take a look at solving this problem. So we have our worksheet that we saw in Exhibit 3.13 in the textbook under Learning Objective P2 for adjusted trial balances. And now we're just going to complete things. So first, we'll have cash of $57 we'll put in. We'll put in receivables. We'll just go ahead and load into the adjusted trial balance all of the data that the company had on their trial balance. And then we have the totals, just like we saw on the previous page, of $320. Now we're ready to begin the adjustment process. So let's take a look at the first adjustment. The first adjustment says that there was depreciation on equipment of $4. So we have equipment of $75. We've used up some of that equipment. We've used up $4 of that equipment. So remember the rule, the portion of the asset used up in the period will become an expense for the period, and so this type of expense will be called depreciation expense. So in our adjusting process, we're going to have depreciation expense. Now, do expenses grow with debits or credits? Well, hopefully you remember that little mnemonic ADE. Assets, dividends, and expenses all have debit balances. So if we're going to increase depreciation expense, it's an expense that gets increased with a debit entry. So we're going to have depreciation expense from Part A. We'll add that onto our adjustment, and our depreciation expense from Part A will be $4. But we have to complete the entry. If we have the debit, we also must have a credit. So the credit goes to accumulated depreciation on the equipment. Remember, that's the contra account to the equipment itself. We don't credit the equipment directly. Instead, when we use up some of the equipment, it gets credited to the contra account. Okay, so that's all for first one, transaction A. Let's move on to B. Accrued salaries of $9. So accrued salaries for $9 means that there will be additional salaries expense. We've accrued some more salary. So we're not necessarily going to pay those out in cash right now. However, there is more salaries to add for this period. So in addition to the $36 of salaries that we saw on the unadjusted trial balance, this adjustment is saying, hey, wait a minute, you know what? We got $9 more of salaries to include for the period. So just like depreciation expense, salary expense will also increase with a debit. Now the offsetting entry for that will be salaries payable. That money's not getting paid now in cash, it's getting paid in the future for cash, so we have a probable future economic sacrifice that's been set up. That's the definition of a liability. So salaries payable is the liability that's set up, all for transaction B. Let's move to transaction C. The $31 of unearned revenue has now been earned. So we see that we have this liability of $31 in our unadjusted trial balance. Somebody gave us $31 for services they wanted us to perform at some point in the future. What this adjustment is saying is now that $31 has become earned. So this $31 credit has to go away. How will we do that? Well, we'll give it a $31 debit. What's the offset going to be? Well, this unearned revenue has now become earned revenue. So on our unadjusted trial balance of $165 for revenue, that's going to go up. It's going to go up by another $31. Transaction D, Supplies available at December 31st, 2016 was $32. So we see that we have supplies of $42, but the balance that we want is a supplies of $32. That means we have to take away how much of supplies? $10. We have to say that we've used up $10 of supplies. So supplies have a normal debit balance. We're going to reduce it with a credit of how much? Supplies are going to get reduced with a credit of $10. And the offsetting entry will be to supplies expense. So see here, we've used up $10 of supplies. Remember the rule, the portion of the assets used up in a period, they become an expense for the period. And in this case, that expense is called supplies expense. Last up is item E, expired insurance of $32. Well, we have some insurance here. Prepaid insurance of $36. Expired insurance should be $32. I'm sorry, we've used up $32 of it. So out of that $32 of insurance that we've used up, we're going to reduce prepaid insurance also by $32. Notice it has a debit balance because it's an asset. We're going to credit it for $32, which is going to leave us a balance now of how much? It's going to leave us a $4 balance of prepaid insurance. Okay, so that's a quick look at these 5 adjusting entries using the worksheet. Now we can take those adjustments and we can total them up for the period, and the debits should equal the credits of $86 each. Next up, we'll conduct the adjusted trial balance. We're simply going to take these balances, add debit to debit balances, subtract out credit from debit balances, do the opposite for credit balances, subtract out debits and add in credits, and that'll come up with our adjustments. So no adjustments for cash, so cash is going to be pretty easy. That stays at 57. Account receivables, that stay at 20. Notice what happens with supplies. A debit of 42 less a credit of 10 will give us $32 in supplies. We talked about prepaid insurance, so that's going to be $4 left here because we have a debit of 36 less a credit of 32 will give us $4 in supplies. No adjustments to equipment, but there is an adjustment to the equipment contra account, accumulated depreciation equipment. Notice we have a credit of 33. We're increasing that with another credit of 4 because we've used up $4 more of the equipment. So now our credit balance goes to 37. No changes for accounts payable, that stays the same. Salaries payable stays the same. Unearned revenue goes down to 0. Common stock at 28. Retained earnings at 50. Dividends 24. Revenue 165, but remember we picked up another $31 of revenue. That was from transaction C. We had some unearned revenue that was shown as part of our liabilities that became earned during the period, so this went away and it brought in more revenue for the period. Now total revenue is 196. Salaries expense went up from 36. We added more to it of 9, so now it's 45. Utilities expense stayed the same. Depreciation expense increased by $4 from 0. Supplies expense were 0 and they increased by 10. And insurance expense was 0 and it increased by 32. So now we have our adjusted trial balance that we can total, and it better total the same on the left and the right side or we did something wrong. So total all these up and it should total to 333. Total all these up and they should also total to 333. Last up, we can put together the income statement of the balance sheet. Now the income statement is basically put together for us. It's just these revenues minus these expenses. And the balance sheet will just be these assets against these liabilities in the stockholder equity accounts. So let's finish up the income statement of the balance sheet. First with the income statement, revenue, then salaries expense, utilities expense, depreciation expense, supplies expense, and insurance expense is all carried over. Expenses total 121. Revenues total a credit of 196. And that leaves us net income of $75. Our totals then will be 196 and 196. Let's finish up the balance sheet and we'll be all complete with this problem. Cash gets carried over, account receivables get carried over, supplies get carried over, prepaid gets carried over, equipment gets carried over, accumulated depreciation is a credit that gets carried over, accounts payable, salaries payable, unearned revenue is now 0, common stock gets carried over, as does retained earnings, as does dividends. We've brought all the accounts over for the balance sheet side, and now we can total those up as well. Subtract the smaller from the larger, and our balance sheet will now be in balance.